In this video, I'm going to make my case for why Qualcomm is an excellent AI stock to buy before 2025 and hold it for longer than 2025. The justification I'm going to use to make my case is the company's revenue growth, the operating margin and cash flow expansion, the valuation, both in terms of the forward price to earnings and the discounted cash flow model valuation estimate, and the fact that the company is expanding into new product categories and finding success. So I'm going to share with you all those details as to why I think Qualcomm is an excellent AI stock to buy. Let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking at Qualcomm's revenue growth going back a decade, the first thing you'll notice is the volatility up and down, right? It's a semiconductor company in a semiconductor industry that's volatile and experienced unprecedented levels of volatility during the pandemic and coming out of the pandemic. So that only added to the already volatile industry dynamics. However, Qualcomm is coming out of it very nicely here and generated 19% revenue growth in the latest quarter and has forecasted that the good times will continue heading into next year. The company is expanding into the personal computing industry with its processor technology, and it's coming into the industry at an opportune time, just as the PC industry is entering into arguably its largest replacement cycle in its history. So it has that going for it strongly. And then it's also expanding into the automotive industry, which it's further into. It's been a couple of years now that it's in the automotive industry, and that part of its business is growing much faster than the overall company at revenue growth rates. So those growth categories are adding to its smartphone business that's also growing as people are upgrading their smartphones, and not in the sense that you might think upgrading like, taking their 2-year-old phone and getting a newer one. People are doing that as well. But what is happening within the smartphone industry is that people are getting more premium smartphones. Instead of getting that $300 smartphone, people are getting the $400 smartphone because those added features are now becoming more attractive and people are going for that more expensive smartphone. And that's benefiting companies like Qualcomm because the more expensive smartphone has more components inside, and the more components inside, that's benefiting a company like Qualcomm because they get fees for inserting more components into these smartphones. So these factors adding growth to the company. Of course, one factor that's taking away some business is the export restrictions to China and the company losing some business in China there as a result of those restrictions. Cash flow from operations is also solid for Qualcomm. Volatile, to be sure, you can see the big ups and downs here, but it has remained positive throughout. The lowest it reached was about 10% in 2019 in a trailing 12-month period, and the highest it reached was about 35%. On average, the cash flow from operations has sustained at about 24-26% throughout the last decade, and I wouldn't be surprised if the next decade, the company's cash flow from operations is actually better than the previous decade because it has those new growth categories, adding incremental revenue and cash flow to the business operations. Remember, Qualcomm is a semiconductor design company. It doesn't do the manufacturing in-house, it outsources that. Although there was rumors that Qualcomm was interested in buying Intel's manufacturing assets. That remains to be seen if Qualcomm wants to go down that route that the market does not like, right? The companies that do both design and manufacturing, the stock market has punished them with lower valuations. The stock market has favored those semiconductor companies that do one or the other, either design like Qualcomm and Nvidia, or just manufacturing like TSMC. So going into both markets have not liked that. And I think Qualcomm will take that hint. And if they are to decide to do something like that kind of strategy, they'll approach it more cautiously. Operating margin, a similar story to the cash flow from operations. Solid numbers, right? Volatile to be sure, but solid numbers at 26% trailing 12 month. Return on invested capital, again, similar story. 26% is an excellent return on invested capital. Now, if I were to, get really wonky here, if you were in my corporate finance class at university, we would be talking about the return on invested capital versus the weighted average cost of capital. And what you'd like to see in general is a return on invested capital that's higher than the weighted average cost of capital. And for Qualcomm, it is. It's more than double its weighted average cost of capital. I won't get into more details than that on this very wonky subject. It's very detailed and advanced finance stuff. But I will, in general, highlight that it does have a better return on invested capital than its weighted average cost of capital, which is a very good thing. Okay, now that we've looked at the performance metrics, we can look at the valuation, which looks attractive. A forward price to earnings of just 13.06 for a company that's growing revenue double digits, as we saw in the latest quarter. Now, I don't think the double digit revenue growth will persist for a long period, like 5-10 years, but I think it could persist for the next 2 years as the company advances into those new markets, PCs and automotive. And you're getting that at a forward PE of 13. This is near the cheapest you've been able to get this stock. I mean, it reached lows of around 10, a forward PE of 10, but it hasn't been that low for any extended period of time. So forward PE of Qualcomm of 13, I think, is a good value. And then also, if we consider the company's discounted cash flow value, my calculation for Qualcomm's intrinsic value per share has it at $200. The current market price is $156. So whether you look at the forward PE multiple as the valuation metric, or whether you look at the discounted cash flow valuation as the valuation metric, they both point to the same thing, and that is that the stock is undervalued. I'll touch on my weighted average cost of capital. You see here, I calculated that for Qualcomm. I had my weighted average cost of capital at 11.5%. And remember, the return on invested capital for Qualcomm was over 25. So it does meet that criteria. It does have a much higher return on invested capital compared to the weighted average cost of capital. It has a higher intrinsic value than the current market price. And the forward PE multiple is attractive at 13. So for all those reasons, I think investors looking for an AI stock to buy for 2025, I think Qualcomm is an excellent choice for you. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.